Welcome to Mango Spaces at this Tuesday evening. It's to discuss car in general. We have the CEO here. Vijay, maybe you can reintroduce yourself. I know you've been on Mango Spaces before several times, but it's been a while. So it's a good time to maybe to reintroduce yourself and tell us a bit about what you do at Car in General yourself.
Great. Thank you, Eric. So I'm the CEO of Car in General. I've been the CEO now for 30 years, actually, and one of the oldest serving CEOs, funnily enough, on the stock exchange. And I've been involved with Car in General for over 30 years. We restructured the business in the late 90s. Our first business actually was the Alfa Romeo business, which we started in 1999. That wasn't overly successful, so we closed that in 2002. And then eventually we went into the motorcycle business in Uganda to start with, and then basically expanded into the motorcycle business in East Africa with TVS, which is our primary brand. And then we went into Piaggio, which is the three-wheeler brand. Then after that, we went into some equipment brands like Cummins, like Toyota forklifts, Kubota tractors, Develon construction equipment, Ingersoll Rand, and some allied brands like the MRF tires and Motor Oil. So what we effectively run right now, and then eventually we also went into finance with our investment in Watu. So when we look at our business right now, we're effectively in 5 different streams. One is our automotive and equipment distribution business, which is our consumer business, which is our bikes, three-wheelers, and consumables relate there too. Our equipment business, which is our Cummins business, our Ingersoll Rand business, our Toyota forklift business, our compressor business, Ingersoll Rand, our Kubota business, which again caters to another ecosystem. So that's the automotive and equipment distribution business. We're in our finance business, which is Watu, where we finance two-wheelers, three-wheelers, and phones. We're in the real estate business. We have a mall in Nairobi, Nairobi Mega. We have our own properties, which we rent to ourselves. And we've got some other commercial properties. We're in the poultry business in Tanzania, and we're in the helmet business, which produces accessories, including riding jackets, which cater to our motorcycle ecosystem throughout East Africa. And so essentially, those are our 5 business lines. And we're across East Africa. Our Watu business is across Africa right now. And we think we're well set for the future. So that's a quick nutshell. If you'd like me to expand on anything, happy to do.
I think we can go through each of the segments a little bit so that you can get a bit of flavor on where you operate in terms of market, segmentation. You talked about very big brands there, Ingersoll Rand, Cummins, very global brands. I wanted to understand also how you get to partner with some of these brands and how you become like the distributor of some of their products. How's that relationship?
So that actually is a very good question. And it's something we've been very deliberate about, because one of our missions is to be the number 1 or number 2 player in each market. So we'll only align with a brand which we feel can actually achieve that with the right execution. And essentially, it's taken a while to accumulate those brands because they don't grow on trees. And we really had to be very specifically targeted to those brands as we saw them appear and as we saw an interest in East Africa. So it's taken a number of years to do that. The last of these brands was collected in 2015, and it's taken literally 13 years to collect the brands that create the portfolio that we have today, that gives us a platform to play in the ecosystems in which we play on multiple fronts. And so it's been a lot of hard work doing it. We're lucky to have got them, I think. We really have got market-leading brands. And we feel, as I said earlier, that we have a platform now that we can really build on as the region begins to expand.
So take us through the various business segments slowly by slowly so you can understand how each is positioned in the market.
In terms of the brands or in terms of the 5 businesses I talked about?
The 5 businesses, but you can mention the brands now and give a bit of flavor on some of these brands, what they do and how you partner with them.
So our automotive and equipment business is predominantly East Africa based. So our consumer business is the two-wheeler by TVS, the three-wheeler by Piaggio and TVS, and then the allied products that relate to it, i.e. the tires, the oil, the spare parts, the whole ecosystem that relates to it. That's probably the biggest chunk of our distribution business, forming around 70 to 75%. Then we have the equipment businesses, which is our Cummins generator business and the parts that go with it, the Toyota forklift business, the Ingersoll Rand business, the Kubota tractor business, and the Develon business, which forms 25 to 30% of our business across the region, and which is now developing quite rapidly given the infrastructure and the other plays happening across East Africa. So that's essentially our automotive and equipment distribution business. Our finance business is in 8 countries across Africa. So obviously, Uganda, Tanzania, Kenya. We're now in DRC, we're in Sierra Leone, we're in Nigeria, and we've opened up in South Africa. So those businesses are now stabilizing. They're now growing. The East African businesses are obviously doing well, and the businesses across Africa are stabilizing. And the plan is now to see whether we can increase that outreach to cover a few more countries in Africa. And so those two businesses are big businesses in terms of size, around a couple of $100 million or above each. And then we have our real estate business, where we develop real estate for commercial use. We also obviously develop our own real estate for own use. And then we have the helmet business, which goes with our motorcycle business, helmets, riding jackets, vests, which goes with our motorcycle business across the region. We're now exporting to motorcyclists throughout the region, in fact, 8 countries. And the plan is to now see whether we can expand that across Africa. And then we have finally our poultry business, which is very Tanzania-based, only in Tanzania, and forms a nice little niche business in the Tanzanian space. And we run a relatively dominant market share, number 3 in the market. So quite a positive business and a very interesting business for us to be in.
I wanted to understand, when you go into a new market, because you operate across a very broad range of countries that you've mentioned there, what's your strategy there when you enter a new market? Do you seek some partnerships, or do you acquire some business? Or do you do greenfields straight from the ground up, or what do you do? And how do you know that there's an opportunity in a new market? Are you visiting constantly some of these markets?
Yeah, we do it demographically. So if you look at our products, they're quite demographic by nature. You know that the big populations will consume more 2-wheelers and 3-wheelers, but more phones, more finance. So population is a key thing. So if you look at the markets that I've talked about, they tend to be the larger markets or the markets that we understand. Obviously, East Africa is easy for us. We've been in East Africa for many years. But when we look at other markets outside East Africa, it's really based on size and opportunity so that we can scale up as quickly as possible. Because in all our businesses today, scale is really important, giving the pressure on margin and given the pressure on costs.
So in terms of revenues, 2024 was a difficult year, 2025 was a better year. And perhaps some people don't know that you changed financial year. Now you're December oriented. Could you take us through the change in reporting period? And then secondly, how 2024 was compared to 2025 in terms of overall top line growth?
So 2024, so why we did the change, frankly, was because Watu has become an increasingly large business. Their year ends at January to December because of financial regulations. So it made sense for us to have the same year end so that we have the same audit period. So that explains why we made the change. In terms of 24-25, I think our consolidated revenues for 24 were 20 billion. Consolidated revenues for 25 were 25 billion. And so 21% growth. That obviously excludes Watu, which we don't consolidate. That business obviously grew fairly fast over the year, 60% up. So I think it was a very positive story where we were in 23-24. Which were very difficult years given the collapse of the motorcycle business across the region because of macro factors, because of micro factors as well. But those were very difficult years. So when we look at the 25 results compared to, say, the 23 and to an extent the 24 results, we're very happy that we've been able to deliver a positive result in 25.
As the 2-wheeler market recovered fully, you had a figure around 8,000 there in terms of sales. Could you take us through how you cover with those numbers? Are they specific to you, or is that the general market?
So that's the general market. So the 2-wheeler business basically expanded from 4,600 units 2024 to 8,000 units in 2025 in Kenya, that is. In Tanzania, the figures are slightly different. In Tanzania, they didn't decline so much in Tanzania. They were around 18,000 units in Tanzania. Now they've gone up to about 25,000 units. So Tanzania was less severe in terms of the drop. The Kenyan market 3 years ago was 20,000 units a month. It then dropped to 4,600 units for over 2 years. Then it's gone up last year to 8,000 units. And we're expecting this year that we should see a bounce back to around 14 to 15,000 units. So I think it's quite a positive story in terms of the growth of the market, which obviously we benefit from given our strong market share.
There's a replacement cycle within the motorcycle industry. What drove that downturn and what's driving this upturn in terms of fortunes? And what gives you that positive outlook as you look at 2026 especially?
So what drove the downturn? You'll recall that we had huge currency devaluation. So we went from 100 to at one point 165. Obviously, pricing had to keep up with that. And what essentially happened was that at 165 shillings to a dollar, the bike pricing based on that became very high. And when you consider that you're buying a bike as a commercial product or a 3-wheeler as a commercial product, when you hit those kind of levels, it's very difficult to make money on it because your income stream doesn't go up commensurately. And when you consider the border market is over 1.2 million border borders, if in 1 year your price goes up, you're still competing with 1.1 million other boda bodas at a much lower price who don't increase the price. So essentially, it became an unprofitable business, which is what led to the reduction in demand. And then what's happened was that the currencies obviously come back to us a bit. So that inflation equation and the real income kind of leveled off, and people had a bit more money. And the net result is that because of the starvation to the market for a couple of years, now what we're seeing is the replacement market taking place in a more profitable 2 and 3 wheeler environment. So that essentially is what's driving the growth, that you're able to make profits from the acquisition of a new bike. And that bike is now replacing bikes that weren't replaced. So it's a couple of things. And we think that if things remain stable, that growth will continue. And we expect to see a positive growth trajectory in the years to come.
What's interesting also, once you go just down at the income statement and you go to the gross profit area, gross profit up around 45% or so to the 4.6 billion. Gross margin is up around 300 basis points there. And it means that you're managing costs even as you increase revenues. What are some of the things you may have noticed in terms of cost aspect of the cost of goods sold in the country?
There are two things. One is the forex stability has helped a lot, obviously. And the reality is it's very difficult to control your margin in a devaluing environment because you're always behind the curve. So you're always caught behind the curve. And as a result of that, you're not able to keep up with your margins. When you have a stable market like we've had, it's much more easy to stay in touch with your margin. So the first thing we've been able to do more successfully, given the stability of the currency, is manage our margin. And then on the cost side, I think we've made a lot of investments in our efficiencies in terms of our digital aspirations, in terms of our IT aspirations. And as a result of that, we've been able to become a lot more efficient as a business. And the net result of that is we've seen stability in margin, efficiency in cost. And those two equations obviously lead to a better performance.
Let's go down a little bit below the income statement a bit. Tell us a bit about the fair value gains as you look at some of the impairment provisions and trends in operating expenses. I will come to the associates a little bit later. What do you see there?
Okay, so the fair value gain, they've been fairly minimal this year. So the real estate markets have been fairly stunted. And so we've not seen any really significant gains. We've seen some small gains in Tanzania on some of our real estate there, but in Kenya, we've seen very limited gains. So the fair value gains have been not significant this year. And from that perspective, what we're seeing is that the real estate market, I wouldn't say is under strain, but it's not buoyant as it used to be. And that's why you see that the fair value gains have been very minimal. They've all fallen below the line before profitability, which means it's really happened in our PPE properties. And we expect that those gains will not be as significant as they've been in the past, to be honest.
A little bit about the impairment, significantly up. What can you tell us about that?
In terms of the impairments, that's for financial assets. That really is just our ECL model, which is quite a strict model. And what it really relates to is just providing for debtors that are beyond our ECL model. So that doesn't necessarily mean that they won't come back, but it means they're beyond our ECL model. So we obviously have to make an impairment for that, given that we have a model that we have to follow.
Operating expenses a little bit up around 17%, but that's below revenue. You're managing quite well even as you keep growing. Any insights?
Operating expenses will grow as your revenue grows, obviously. And right now we're investing very heavily in building our manpower, building our capability. So the investment in people continues. But as you say, they're fairly efficient in terms of growth, but we're also planning for the next level of growth. And when you're basically building a business, you're managing your expenses in advance of the build. I'd say that 17% growth that you see has largely been driven in investments to drive further revenue growth in the years to come. Because as I say, you have to make those investments before the curve.
And what are some of the things that you're seeing there in terms of trends? So there's a lot of talk around AI and all that. Do you see that impacting car in general directly? I know there's a lot of talk in the market, but you on the ground, and then also something else that I know about you is that you pay close attention to cost very keenly. Is that something that's spreading across the organization as the company grows?
Oh, definitely. In fact, AI is a very major push for us right now. We see AI as being potentially a huge competitive advantage for us going forward. And so, yes, our investments in AI continue. We're running 20 AI projects as we speak. And the fact is, embracing AI is going to be very critical for our organization to maintain our competitive advantage. We think it's going to be a real positive. It's really going to drive further efficiency, further competitive edge. So we're very committed to that journey for sure.
And are there specific things that you're seeing perhaps in the AI? Are you maybe developing some self-driving two-wheelers here and there or three-wheelers?
No, I think self-driving 2 and 3-wheelers is a while to come, to be honest.
I just wanted to have a feel of the projects that you're having. Could you give us some pointers on what you're seeing
So
there?
on the AI side, first of all, if you look at the very basics of AI, all it does, it drives efficiency, right? So we're really embracing the very basics of AI, and it's very simple. So the ability to communicate more effectively, the ability to make calls effectively. So for example, in our Watu business, we'll make 90,000 calls in a month through an AI tool, which makes it a lot more efficient than having thousands of people doing it. But so that really is efficiency on the AI side. So we're embracing it to build efficiency. What we see happening in the future is that we'll become much more consumer responsive through our AI processes. And so that's something that we're really working on to see whether we can become more predictive in our consumer requirements. And so we're working hard on that one as well. And that's currently in the experimental phase, but it's a phase that's really going to kick in, we think, over the next couple of years as our AI tools develop and our AI capabilities develop. In terms of the other projects we're running, though, when you look at our EV projects, when you look at how we predict battery behavior, consumer behavior, that's all going to come through the AI tools that we're developing. The AI journey is a journey. Right now, we're at base level, and we see over the next 2 to 3 years, we're becoming more advanced. And we're really going to aim to invest in it in order to continue to build a competitive advantage. As I said, we think it's a critical flank to increasing our competitive advantage.
Let's talk about associates. Watu Credit is in there. So could you tell us a bit about the relationship between current general and the associate is like in terms of business relationship and how you build and sometimes how you just select which companies to invest in that regard? And tell us a bit about how the share of profit in associates are developed in 2024, 2025.
So in 2017, we bought a small stake in Watu, 29%. And the idea behind that stake was to really become a financier of two-wheelers and three-wheelers. And it frankly grew beyond sort of imagination. So we started in Kenya, obviously. We went into Uganda and Tanzania, managed to scale a business there as well. And now, as I said, we're in 5 other countries across Africa. And it's proving to be a product that obviously caters to the masses, including the phones, that is. And we see great potential in the product going forward. So we're very, very confident that we'll continue to see progress in that associate. We did have an associate in terms of Cummins. We had a joint venture with Cummins at one point. We bought them out in 2024, and now basically it's a wholly owned subsidiary. So it's no longer an associate of ours. So the biggest associate we have in our books right now is the Watu business.
So tell us a bit about the business in terms of the significant uplift in terms of profit for 2024-25. What did they do differently?
I talked about the motorcycle business having a large drop. Now, obviously, at that point, we were very heavily involved in the motorcycle business. With the drop in the motorcycle business, with the drop in profitability of the motorcycle business, we basically had to scale back our ambitions in those businesses, the 2 and 3-wheeler business. We also saw a very large default rate at that time, simply because the profitability, as I said, had left the business. And as a result of that, we had to take a significant number of impairments. What we're seeing now is that the business, with the recovery that we're seeing generally, is now back to profit in terms of the bike business, in terms of the 3-wheeler business. But during this phase, what we also did was transition into the phone business and frankly developed a very good business in that area. And now it's a question of continuing to work on the sustainability of the business going forward across many markets, across several layers. In other words, how do we layer up in order to make sure that the business over the medium term build more sustainability? So it's a very interesting business, scaling relatively fast, and a bit like our other businesses. So we're very positive on the prospects of that business as well.
And then if we go down the income statement once again, I think borrowings doubled last year, and then also finance costs doubled, and I think finance income almost tripled there. Could you tell us a bit of how you're thinking about debt in terms of taking up to grow the business and how that is informed perhaps by the lower interest rate environment that was present last year and the year before?
So obviously the lower interest rate has helped, but borrowing didn't double last year. Borrowing actually did. The different lines of debt remained relatively stable. Finance income, so if you look at our balance sheet, we had 800 million in cash. Obviously that delivered finance income, which is what is finance income right now. I'd say right now, this level of profitability, at this level of growth, at this level of turnover, I'd say that our balance sheet is not entirely optimized, but it's very close to being optimized. And in fact, the inefficiency in our balance sheet really today lies all our real estate holdings, which are not sufficiently productive. But otherwise, from a distribution, trading, finance business, we trade that our balance sheet is very close to optimal, actually.
When you say the real estate is not optimized, what do you mean by that? Is that because of the kind of tepid environment that you have in real estate currently? Are you looking to, like we've seen lately, some institutions like Stan Church look to offload some of their real estate and just become lessees in a way? Is that something that is in the offing for you?
Not necessarily, but it's a good question. So what I mean by not optimized, in real estate, there are two forms and two streams of income. One obviously is your rental income, and the other is your revaluation gain. We spoke earlier about the fact that revaluation gains are a bit minimal. So that's one line of income on real estate that has not been kicking through as much as you would expect in real estate. Real estate, if you look at it traditionally, has always gone up. But right now, what we're seeing is a stabilization in real estate value. So that takes away a line of income on real estate. The issue with the real estate is that all your properties have to release income. So if they're not growing in value, then they must be income producing. And what we have is we have a couple of properties which are not going up in value, not income producing. And that's where I talk about the values of real estate not being optimal in terms of balance sheet optimization. So what's the answer? The answer is to develop some of it, which is what we're looking at. So that's something we're very actively looking at. And what we expect in that process is hopefully we'll see some gains kicking through again so that we can rebalance our real estate holdings.
So how does an optimal balance sheet for you look like then going forward? What are you aiming at?
So we're aiming at some very key parameters. One is, if you look at our debt to EBITDA right now, it's approximately 1.5 to 2 to 1, which is not far off. It's not bad, to be honest. So what I would like to see is a debt to EBITDA 1.3 to 1.4 to 1, which is what we're going to be working on this year in terms of debt to EBITDA. And then also we're looking at our things like our return on equity. We're aiming for 25% return on equity. Obviously, last year we exceeded that. So that's the other key parameter. For that to happen, we obviously have to carry a degree of debt. How we optimize our balance sheet is basically by looking at some key parameters and making sure that within those parameters, we're in a healthy condition. And then also sure that in the event that things turn down, we're safe. So those are the principal areas. It's almost a science, to be honest with you, Eric. But making sure that key parameters are in balance is very important to us. And right now, when you look at last year's balance sheet, we're not far off. Our return on equity is good. Debt to EBITDA is good. When you look at our asset base, it's solid. When you look at debt to equity, it's solid, 1 to 1 or slightly less than 1 to 1. So those are all solid parameters for us. But ultimately, your business needs to perform at a level that allows you to carry the debt. And the debt to EBITDA that we currently carry allows us to perform at a level that currently is satisfactory.
What I like about the VJ, I think generally you're actively thinking about balance sheet optimization, income statement, and all these components that flow into each other in terms of making a good business in the end. I see profit was up significantly this past year. Is that something that you see sustainable, especially if you look at the cash flow from operating activities? They were slightly down. How would you want people to think about the cash flow statement going to next year, and especially the profitability aspect of it also?
I think we're assuming we have stability from the Middle East. We did cover this in our chairman's statement. We're hoping that the Middle East resolves it or doesn't have a major impact globally. It's obviously having a major impact globally, but doesn't have a major impact on East Africa. If we maintain stability, exchange rate stability, interest rate stability, inflation stability, then what we see is our business continuing to grow and profits continuing to move in a positive direction. Because as long as volume continues to move in a positive direction for us, then profits will move in a positive direction for us, assuming everything remains stable in the process. And the beauty about our business is that it's a cash flow business. When you look at our distribution business, excluding Watu here, of course, but when you look at our distribution business, it's a cash flow business. It's a very efficient business. So long as we trade profitably and at the right margin, we expect to be generating positive cash flow. Yes, we might invest in plant and equipment, as you've seen. We might invest in inventories, as you've seen. So yeah, there will be some investments that will happen. But if you look at last year's results, we generated 500 million in cash from our distribution business. We consider that to be a positive result, given the performance of the distribution business. But no, we're quite positive that the distribution is heading in the right direction, and with the finance is also heading in the right direction. We don't consolidate that balance sheet, It doesn't feature into our cash flows as such. But we also consider that business cash flow wise is on a positive trajectory.
Thank you for that. So once the profits are in, the cash is in, you've been pretty generous with the dividends this past year. Our shareholders are pretty happy. What informed your dividend distribution this past year? And is that something that is setting the bar for the future so that shareholders would think of that as a base?
So in terms of our distribution, we have an unwritten guideline. I wouldn't say it's a policy as yet, but it's an unwritten guideline that we'll distribute close to 30% of our distribution profit after tax. Distribution of the distribution business. So if you look at our distribution business, you analyze the numbers a little bit more closely. We made in the region of 850 million after tax, which means that the dividend that we've issued of 250 million, close to the 30% benchmark. Would we like to keep it at that, given that we don't actually invest heavily in capital expenditure? The answer is yes. So long as our balance sheet is optimal, as you and I just discussed, we'll try and maintain a dividend policy that makes sense for our shareholders. If it's not optimal, then obviously we'll have to plow more cash into the balance sheet.
I want to go through some of the comments that you made, especially in your management commentary, which was very insightful. I want to start with the progress. Let's look across the region. How's the progress in Tanzania, distribution and poultry? I want to see more expansion across Africa. Take us a little bit around the continent in terms of how you're seeing some of the businesses developing across that. Tell us a little bit about the Rwanda office showroom, if it's still there or you closed it. Just take us across the region and how the business is performing.
So if you look at our segment information, which is in the balance sheet, what you'll see is that our Tanzania business last year was slightly larger actually than our Kenya business. And admittedly, our Kenya business was coming off a low base because we'd obviously struggled in the previous years. So it was coming off a low base. If you look at our Kenya business, it was clocking about 11 billion. If you look at our Tanzania business, it was close to 12 billion. And so when you look at those figures, we pray that the diversity, that spread is very positive. And equally, when you look at the Watu business across the continent, what you'll find is that now more and more of the countries that we've seeded, which is the DRC, the Nigerias, the Sierra Leone, are coming to the party in terms of profitability. Tanzania has really emerged as a big business. Uganda's already emerged as a big business. So when we look at the whole sort of scenario, we see good diversity, good regional diversity, good product diversity. So we're very positive about the prospects going forward, so long as the stability I alluded to earlier is maintained. And Rwanda, you asked the question. Rwanda was frankly poor for us. And so we exited Rwanda simply because we couldn't scale up the business sufficiently to make a satisfactory level of profit.
The EV market there seems to be pretty strong. Maybe you can also use that as a segue to discuss the EV market in Kenya and how that's progressing. The two-wheeler, the three-wheeler, how's that going?
So that market is going well. And so right now, when you look at total EV sales in Kenya, they're up at about 12% last year and growing slightly. So we see good progress happening. We still think that the EV business is even in an experimental phase. So right now, there are quite a few swap stations that we built. I think we mentioned 350 between Uganda and Kenya. But that's experimental. We're still trying to find the right product fit, still trying to make sure we can scale out the battery charging station for both two-wheelers and three-wheelers so that we can run really viable two- and three-wheeler EV businesses. But I think we've made a lot of progress. I think we've seeded it nicely. I think we've learned a lot. And we think over the next 10 years, we'll see a much more significant scale up in the EV business. But the other very interesting business for us is the CNG business in Tanzania, if you press that for us. Now, you can see that with Tanzania's gas reserve and the ubiquity of supply right now in Tanzania, the CNG business in Tanzania is really going to kick through over the next 5 to 10 years as well. So what we see over the next 5 to 10 years is that both these businesses offer a lot of runway. The question is, how relevant are we in them and how much do we play? And we're very positive about the CNG business in TZ. We're very well settled there. The EV business in Kenya and Uganda is still a business that I think it's finding its footing, and we'll hopefully find our footing in those business in the short term, in the next 2 years. And we hope that in the next 5 years, we'll become dominant players in those businesses as well.
When you look at the EV business, I think something I've noticed from earnings calls from other companies, especially the global ones, is that because of the crisis in the Middle East and the fuel prices being up crazily, I think one consideration has been that people are moving more and more towards taking up more EVs. Is that something that you're seeing in Kenya? Is that a little bit more interest in the past couple of months? in the EV space as the crisis unfolds?
No, you're definitely going to see it, 100%. So, and if you look at the mathematics of the EV business or the CNG business in Tanzania that I'm alluding to, so the mathematics work. And with the global crisis, you can see that EVs are becoming more popular. You look at Toyota's results, which were recently introduced. Almost half their vehicles have been hybrid vehicles. So there's no question that with the crisis that's emerging, there's a greater attraction to enter the EV or the CNG business. So there's no question about it that there's going to be a promotion of those businesses as a result.
You talked a little bit about the crisis in the Middle East region. Maybe you can expound a little bit how that's impacting business directly. Is it maybe through the fuel costs? Are you seeing a little bit of maybe impact on the businesses around the country? We know this week is when the fuel prices are supposed to be going up slightly further, I think in 2 days or so. What's the feedback you're getting from the people on the ground and especially your customers in terms of how business is being impacted by the Middle East crisis?
Obviously, when you look at the fuel cost going up 20 bob in Kenya, 30% in Tanzania, it obviously affects the mathematics of the business. Does it affect it drastically? The answer is no. Because if you're taking 2 liters of petrol a day, it's costing you an extra 60 bob, 50 bob. In Tanzania, a little bit more. But the reality is that's not enough to alter the mathematics of the business. Having said that, if you have a fuel price of $200 and above, $200 a barrel and above, then yes, then you start getting into dangerous territory. But we've been at 110, 120 before. Right now, I think it's at 105, 106. At these levels, it's not a train smash. But if it jumps significantly higher, then obviously that's going to have a major impact.
Coming back to the EV market a little bit, what percentage do you think in the Kenyan market is EV when you compare to ICE in most of these, especially the two-wheeler market? And what's your strategy around growing market share there? And especially if you look at the 8,000 bikes that are sold last year, as you said, how many of those are ICE?
So if you look at the EV market in Kenya, it's about 12%. It's mainly Nairobi-based because obviously the charging infrastructure is here in Nairobi. And from that perspective, it's quite a significant share. In terms of where do we play in that? On the three-wheeler business, we're seeing the same trend, that the EV players are now emerging and seizing more and more market share, assuming that they can create the charging infrastructure. So it's definitely a threat to our business. But given our strong brand positioning, given our strong distribution network, we feel that when we really do commit to the business, once this experimental phase is over, that we're very well positioned to actually become a dominant player in those businesses. So are we worried? Yeah, we're obviously very aware as a threat. There's obviously a threat that's emerging. Do we think that we can become a significant player in the space? The answer is yes, but we just want the market to settle a bit. On the CNG business in Tanzania, the compressed natural gas business, we're already very well positioned, and we feel that we'll be able to dominate that business going forward.
On the dividends aspect, the closing of the register is after the AGM. And the payment is a week later. Why was it not done before the AGM, by the way?
So the new rule is that you can only pay your dividend after it's been approved by the AGM. We've traditionally paid it on the day of the AGM, but the new rule is that your book closure must take place after the shareholders have approved the dividend, which if you think about it, makes sense. So that's why you see that now it's a few days afterwards, 5 days afterwards.
So in terms of then the overall business in 2024, 2025, let's sum it up for someone who's just joined us. What is the key takeaway that you should take away from the past 2 years in terms of performance and as we head into 2026 especially?
So I'd say 2025 was a really positive year for us, given where we were in 2023. If you'd said to me in 2023, this is how you're going to perform in 2025, I would have accepted that with open arms. So I'd say it's a huge relief that the business has now really found an upward trajectory again after what was a very difficult year 2 years ago. And I think right now we have every reason to be very positive, and we hope that the trajectory will continue and that our operating performance will continue to improve.
And then next year is an election year. You've been through election cycles before. What are the trends that you usually see around the election period and how are you preparing? What's your playbook around the election period?
So we've seen it in Uganda. We saw it in Tanzania. Yes, there was disruption during the election period. But we probably expect the same in Kenya, given that it's obviously politics prevailed. So, but the beauty is, I talked about the diversity of our business. Today, I think we're sufficiently diverse that some disruption in one market for a couple of months will not have a catastrophic impact. It'll have an impact, but it won't be so bad, given what we've seen in Uganda and Tanzania and what we expect in Kenya. Obviously, if it's something a lot more prolonged, then it could have a major impact on some of our key markets. But right now, what history has shown us, certainly in the last 2 years, is that there's been a little bit of disruption, but not crazy disruption to materially affect the business.
How do customers usually behave around this election period, especially from the experience in Tanzania late last year?
Well, obviously, Tanzania for 3 weeks, I think, actually closed down. So it was very difficult. Obviously, no one's buying anything because of the disruption that was taking place. Uganda, similarly, with their internet blackouts during both the election periods in those countries. So, yes, it obviously affects consumer buying behavior. So, yes, we have a lull for 3 weeks, 4 weeks, but then the business kicks through as soon as normalcy resumes. And so our only hope is that any disruption is short-lived and that normalcy resumes quickly.
It's been 90 years now since the founding of Khan General. Any reflection on that? A very robust history, I would say, because 100 years is 10 years away. What are some of your key takeaways as a leader yourself in terms of running the business and what you've learned there from the history of the company? A few tidbits here and there.
I think the biggest takeaway for me is that we have to keep reiterating. And we have to now reiterate much faster than we reiterated before. As we've just discussed the EV space, we've just discussed the CNG space, we've just discussed some of the big trends that are happening across the continent. There's going to be lots of opportunities in the continent, but the nature of that opportunity is changing rapidly. We talked about AI, we talked about all of it. So the question is, are we innovative enough? Are we on top of our business enough to keep reiterating and reiterating fast? And that's the key takeaway. It could be 90 years old, but what's relevant is the next 5 years. So it's literally short term, stay ahead of the game, keep innovating, keep reiterating, and stay ahead of the pack. And it could be a completely different business in 20 years from now.
Yeah, and in terms of competition in the market, how has it developed, as you would say, the past couple of years? As you say, you need to stay ahead of the competition. Do you see it becoming stiffer or a little bit lighter, or how is it? You're pretty capital intensive also as a business. Are there any major capex investments that you have in the offing that you're thinking about in terms of investing for the next many years, as you say yourself, that you want to invest for tomorrow and the day after?
So in terms of how do we see competition emerging, competition is always very stiff. In East Africa, given the liberal markets that we operate in, it's always very stiff. The competition will keep coming at us. It'll keep innovating as we're trying to do. Question is, can we innovate faster? Can we stay ahead of the game? Can we continue to build competitive edge? In terms of CapEx, actually, we're pretty CapEx light as a business, to be honest. Our investments will be more in inventory and working capital, given the fact that we're a distribution business. Obviously, our finance business is fairly intensive in terms of continuing to raise finance. And so we just got to stay ahead of those cash flow curves and make sure that the existing business, because of the growth, not because of any other reason, because of the growth. And we just got to make sure that the businesses that we operate in are efficient, cash flow positive businesses in spite of having to invest continuously in growth. It's a balancing act. And managing those key parameters I was talking about earlier are really critical to ensure that we basically grow in a managed, safe manner. And I think that has been a very key takeaway. And the more solid we can make our balance sheet whilst times are good, the more solid we'll be when times are good, and obviously much more solid when times are not so good. So right now, it's a real focus for us, not only to stay ahead of competition, but to continue to optimize our balance sheet as we go forward.
I'll give you a chance to give closing thoughts and to invite people to join you in this journey of building Khan General, perhaps as a shareholder, also as a customer. Where can they find you? Where can they find your products? And just sell yourself away.
My office is in Lusaka Road. We have an open door policy. You can walk into anyone's office at any time. We're a very transparent business. You can see everything about us just by reading our financial statements. And we're very happy to engage, very happy to remain connected, and very happy to be part of the journey of Africa. And we're really looking forward to the continent taking its rightful space in the global environment over the next 20 years. And we really want to be a part of that and give back to society, give back to the communities, and play our role as well in terms of impact, which I think we're really well positioned given the number of customers we have. We have over 5 million customers today. In the next 5 years, we're probably going to be closer to 30 million customers. So that is a huge platform on which to do good for society as well. So it's a twin engine approach. One, yes, we have to make commercial sense. Two is we have to be good for the communities in which we operate.
But a curious question, what to credit? Do you expect to raise your stake in the business, and is the business itself thinking of listing at some point as a whole?
It is thinking of listing at some point in the future, I'm sure, maybe 5 years from now. Are we going to raise our stake in the business? We would love to, but we would have to generate a lot more cash to be able to afford a more significant stake, to be honest. So we think it's a great business, but we'd have to generate a lot more money to be able to invest further in the business in a meaningful way. But we're very happy with the stake we have. We're very happy to continue to participate in their journey as well. And we really think it's a business that has legs and could really transform the lives of many people across the continent.
Any M&A in the offing?
No, we got our hands pretty full, to be honest with you, right? So right now it's keeping our head down, becoming better and better, growing faster and faster, and just building the competitive edge and reiterating ourselves, as I said, in the continuous journey that we seem to be on.
All right, Vijay. I'll encourage my team to pay you a visit. Since you have an open door policy, we'll definitely come around and encourage more people to come and meet you, because I've met you in person and I think you're a very thoughtful leader, and really thank you for the 1 hour that you've taken out of your busy schedule to come and explain to us the business and talk to the shareholders in the business. So as we close, just give us your closing thoughts and then we're done.
My closing thoughts is we have a huge amount of confidence in the continent. We really think this is our time as a continent, as a nation, as a region of East Africa. We think all the parameters speak to it: population, the demographics, the mineral wealth, the land wealth. And when you think about it, this continent right now is really well positioned. And we all have to play our part to make it happen and to generate a continent that can be really proud of itself in the years to come. And the last comment I'll say is today we have 17% of the world's population. We comprise 3% of the world's GDP. That equation has to change. In 2050, we're going to be 25% of the world's population. Can we be 25% in GDP? So that's going to be the big question for us. And if it's not going to be 25, let's try and strive for 15. But that really has to be, I think, the North Star for all of us.
Thank you, Vijay. And thank you for the time again. And thank you for the audience for joining us for the past hour or so. And see you again.
And thank you, Eric. Thank you to the audience. Really appreciate you taking the time out as well. And we look forward to engaging again. And let's hope that we continue on the trajectory that we're on.